He says not here. Kanoni, look here.
Hello?
Not here. Yeah. He says.
Like this.
Morning, everybody.
Oh, so that it doesn't make that funny.
Good morning, everybody. We're about to start. Morning, everyone. Thank you so much for joining us today as we unpack the topic, how do we solve for funding in early stage VCs? I just want to take care of a bit of admin today. I kindly ask that you please switch your phones to flight mode. We're just trying to get a bit of coverage for our streaming link. Kindly, if you can, guys, just do that for us, please. And we just have a running order for the day where we'll have 1 hour of panel discussion. We'll then go into 2 breakout groups just to sort of get into solution mode. And then we'll come back into plenary where we will then feedback to the wider audience. Today, I am not alone. I have a great panel with me, just one person who's missing, and there's just another person who's going to be joining us online. But really, I'd like to introduce Tishania Naidoo from 274 Investments, Catherine Young from Grindstone Ventures, Audrey Farache from Anza Capital, Konanani Rashamuse from Science and Innovation, and Kit van Zyl, who will be joining us online from Life Capital, as well as Kadir Gangor from Sustainable Impact VC. I'm going to give each of the panel members, please, just 2 minutes to introduce yourself and let us know who you are, who you're presenting today, as we then unfold into the topic. Can I start with you, Tishania?
Me. Okay. Hi, I'm Tishania. I'm the principal of VC at 274 Investment Managers. We invest directly into companies.
Awesome. Catherine, can we go to you?
Yeah, of course. I'm Catherine Young. I'm the original founder of Think Room Consulting. Thought that you could make money out of consulting, but we know we can't. But then 4 or 5 years into that, then invested and bought 50% of Grindstone Accelerator at the time. Knife was in a difficult partnership and did that. And then with Kiet and I then figured out over COVID, one of our COVID ideas was Grindstone Ventures, this post-seed fund that we do. We've graduated about 128, 130 companies out of Grindstone Accelerator. And this year, we had a target of 7 countries, right, Grindstone team, by the end of this year. And we've hit UK, Channel Islands, Singapore, South Africa, and we will have 3 African companies represented for our Africa program that starts next month, actually. So that's us, love entrepreneurs. That's why we're here, and that's why we do what we do.
Thank you. Of course, Kadir.
Sorry for the delay. My name is Kadir. I'm representing Sustainable Impact Capital in Dubai. We are a family office-backed venture capital, which is solely investing in UN Sustainable Development Goals. So we invest in entrepreneurs, socialpreneurs, which is committing to UN SDGs, solving any of those issues. So we are investing globally, early stages, and we also investing in other funds as a fund of funds. We also taking an action with the COP28. So we are one of the official financial partner of them. Yeah, we look forward to engage African startups at the event.
Yeah. And Audrey?
Hi, everybody. I'm Audrey Verhagen. I'm the CEO of Anza Capital. We are a VC, early stage VC fund, and we invest in food tech, clean tech, as well as digital African solutions, seed to Series A. We also expanding into Kenya, and then ultimately in 2025 into North Africa. So we've got a stage approach, hub and spoke model, where we started in Johannesburg into our SADC region, then Kenya surrounds, and then ultimately Egypt and surrounds. That's what Anza Capital is doing in our first fund.
Hi, everyone. My name is Konanani Rashamuse. I'm from the Department of Science and Innovation from a unit called Innovation Instruments and Priorities. So what we do over and above policy development around innovation, we are also responsible for innovation and ecosystem support. And as part of that broader mandate, we do provide early stage funding through our implementing agency. We also look at innovation infrastructure support, things like accelerator, incubators, and venture builders. So mainly that's what we do. We see ourselves as a key component of this ecosystem. Thanks.
All right. And lastly, from Keert van Zyl. Keert van Zyl is the co-founder and CEO of Knife Capital. He is a seasoned investment professional, having successfully exited 10 companies under Knife Capital and recently closed the $50 million Series B offshore fund for the benefit of Africa. And we just have a little video of him.
Okay, everyone, it's a privilege to hear from the airport lounge. I'm really sorry that I can't be there today. I really look forward to meeting you all and being in the room physically. Hopefully we can make the technology work, but I had to go to London. I'm via Joburg back to Cape Town and just could not make the timing work. But have fun. You're in good hands with Karabo and team. And I've got some interesting thoughts to share. If anyone wants to follow up on some of those thoughts, you know where to find me. Thanks. Yeah, Keert van Zyl at Knife Capital.
Taking care of this panel. I just want to read a little something before we actually get into this discussion. Capital raising by VCs has decreased by a staggering 64% since March 2021 to Q2 of 2023 on the back of increased interest rates. Over this period, capital raising has taken over 12 months to close, resulting in 43% of VCs stating that they are halting fundraising efforts. On the other hand, the study was conducted by Venture Capital Journal, interviewing 107 LPs, and that LP concerns lie in three main areas, being the length of time before exit, which affects return on investment, the track record, as well as the stage of the VC fund. These factors, combined with tough macroeconomic conditions, have deterred LPs from committing their funds to VCs. So Kadir, I actually have a question for you today. As an LP, what is causing the hesitation to allocate more funds towards alternative asset classes such as VCs in Africa, and specifically South Africa, in the current environment?
I think like when any foreign investment enter to any jurisdiction, they always look at the environment from also an exit perspective. So it's important that the regulation in the region is allow easy enter and exit. So this is something I think very important in the region. I mean, which we see is making us quite difficult to enter. But I think, the whole ecosystem, all entrepreneurship ecosystem should play together in this because, and every let's say every entrepreneur has a goal to span to other markets, right? So the same wise, you have to attract a foreign capital. So if you want to attract more foreign capital, there should be an easy, entry and exit conditions. So therefore, you should, I think, you should work more with the government to make these things happen, because at the end, when you have an easy entry and exit, it will grow the local ecosystem, So that's what I can say briefly about your question.
All right. And I think, Catherine, this touches a bit more for you because you're currently actually raising capital, right? And there's a lot of issues that VCs are currently facing. So my question is then, what are the common issues faced by VCs in raising adequate capital in emerging markets, especially when you're aiming to drive equal distribution of funds to females and diverse businesses?
Yeah, I love the question. A couple of thoughts to just tee that up before the answer. So we officially launched the fund, as I said, in COVID. And we joke about it, but it was an interesting thing. Knife Capital is our partner, so we first had the first tick. You know, there's credibility. They have 10 exits under the belt, so that, from a thesis point of view, made sense. We believed the Grindstone accelerators, really, by God's grace, doing well. We've graduated a number of companies, 128 to be exact. And I speak under correction, only 4 or 5% of them no longer in operation. So, you know, these are good, solid businesses coming through. The one big gap that we did have, that we realized, was that our diversity was incorrect, both from a race perspective and also from male-female perspective. So this was now back in 2020, so we actively went out to say, how can we make sure that we get proper female pipeline? We got over the pipeline for black businesses. I always say, if anybody says in South Africa they're not a good pipeline of black businesses, send them my way. We need programs to get these businesses through. It's not a pipeline issue, it's a distribution issue. But anyway, so then we were meaningfully intentional to go and find a project. Naspers partnered with us, 30 female-founded businesses. So we were backfilling over a long time to prepare for the fundraise. And then we were ready about 2021, started pitching for potential funding, both South Africa and offshore funders, LPs, DFIs. And I think, I'm not sure if there are any startups in the room, I'm not sure, but startups, you know that thing that we tell you, out of every 10 pitches, you may get one call back. We had 88 long list, 66 short list, 48 pitches, about 20 follow-on discussions, and only 6 final pitches. So what were some of the challenges given? The first one was exits. I agree. Like, how quickly, this is high risk, it's post-seed. Can you get these businesses there quick enough? And would we wait long for potential exits and the liquidity events? The second big thing was a very big issue was the size of the fund. 100 million rand fund, too small. That is a big pushback from DFIs and LPs that we got. That was the second point. The third theme was really not believing that we can bring the balance of diversity into our practice, because that's part of the mandate, 50-50, 50-50. And the fourth thing I would say was just the recent grey listing of South Africa has really hindered us a little bit with the offshore potential LPs, and for that we then had to get offshore structures in place. So I think it's those four. So what we're doing right now is just doing them both, continue to fundraise whilst we're just helping these startups to earn revenue so that we can actually just show the traction, because the proof will be in the pudding. So it's a two-pronged approach at this stage.
All right. And I mean, you're touching a lot on the track record, which is very important. And Kadir, you also spoke about like exits. That's something that they actually want to see before you actually invest into these VCs. But then the exits is also affecting the return on investment, right? So my question is then, when the holding period of investment increases, as exits currently are limited in the current market conditions, which in turn affects the return on investment, how does this affect your views to providing capital to VCs? To Kadir, sorry. Yeah.
So I think that's again, you know, the venture ecosystem is growing with the so much of open ecosystem, you know, like entrepreneurs, like local financial institutions, like venture capitals, or I mean, it's again linked to being an open market, because I'm coming from a very open market perspective country, and then so we have seen a lot of benefits of it. So if you if you want to solve this issue, you still have to be more open by working with the regulators, and so when the indeed we are a long-term investor. I mean, we don't want to return in short period. I mean, and I believe also the many investor in my region is looking this in a long term. But the thing is, you know, unless you include the foreign actors and grow the venture ecosystem, this will be always a problem, and it will be a problem, untapped potential always, you know, like, so maybe you could grow much more ventures, and then like exits and you know, entry and exit. If entry and exit won't be a problem, this won't be a problem. Of course, when the exit terms are difficult, it's another point. You know, when we studying the market, it's another point to decide not to enter. So it's one of the facts to keep investor, you know, not investing. So.
Thank you for that. You know, Knife Capital has been able to exit companies, about 10 companies to date, right? And that was in very favorable market conditions. But what we're currently finding is that the average period to exit is now 8.2 years, right? And I have a question then for Kit. With the current market conditions being unfavorable and not attracting IPO exits in emerging markets, which actually further complicates everything, and there's actually illiquid stock exchanges in Africa, what impact does the hampered efforts of exit have on fundraising abilities?
Yeah, look, thanks, Karabo. I mean, there's no doubt that the market is a little bit under pressure at the moment. It has knock-on effects all over the world. We can see layoffs, we can see lackluster returns, stress, cost of debt going up. So that has an effect on VC. I mean, VC is basically just, or VC firms is a switching mechanism between capital allocators on the one hand and startups or amazing innovative businesses on the other hand. And if you start competing for capital from the capital allocators as a VC, there's less risk that gets taken. The returns take longer, as you noted, and it becomes quite difficult to really prove out that flywheel business model. So yeah, I think the effect is manifold. On the one hand, it is more difficult for VCs to raise capital, you know, and the VCs who do raise capital are VCs that have proven past successes. So they have done maybe fund 3, fund 4, fund 2, whatever, and it's not first-time fund managers. So it becomes quite difficult for first-time fund managers or new emerging teams to go out to the market and convince capital allocators, asset managers, pension funds, DFIs, so forth, that they have a differentiator or a moat, or why would they be able to get outsized returns? I think on the other hand, the startups themselves are under pressure because sales cycles are longer, consumer spending don't have as much disposable capital. So, you know, there's definitely a market pressures for spending, which basically means that the business plans take longer to execute. You know, typical startup business plan goes from idea phase, goes from seed phase, goes from Series A through the valley of death, and at some point, you know, the scalability of that startup goes into that hockey stick curve of scalability. Now, the longer that sort of valley of death is, you know, it eats up returns, and it makes it difficult to raise follow-on funding rounds, which means there's layoffs or just conserving capital, not spending as much on growth, extending runway, And a lot of the startups at Series A level and even Series B level are doing at the moment are raising so-called bridge rounds, which say, look, we know we're not going to get the pricing that we're going to get, which we should get if we were 12 months ahead or 8 months ahead or 18 months ahead. So therefore, we're going to raise a safe type agreement round, which gives us at least a bridge towards a Series A or towards a Series B. To put it in simple terms, technically they want to raise $10 million, but they're saying, look, we actually just need to survive first before we can make funders believe that we can execute that $10 million plan. So we're going to raise $2 million in a bridge, which then converts into that 10 when we raise it in June next year or however long that takes. And in the meantime, stay alive. So the typical exit period for African startups needs to be around the 4 to 7 year mark. You know, that's kind of a sweet spot, because it really means that one can have a better chance of turning your money into 3.5, 5 times money, which starts becoming a 30% return if one really looks at VC returns, which makes it respectable. But if those returns are lower and the timelines go to 8.5 years or whatever, then you have to really make more times money to get a decent percentage return. And then again, the capital allocators just say, well, then I might as well go put my money in a less risky asset like a class, like property or listed stocks or whatever. It's not all doom and gloom. You know, in a downturn, innovation trumps. If it wasn't for adversity and difficult times, entrepreneurship wouldn't be this pressure cooker of new business models and disruption, new ways of doing things. In fact, some of Knife Capital's best deals were done actually in the 2008-9 crunch. In retrospect, some of our biggest fintech exits, etc., etc. And if you look at the Googles and so of the world, you know, in that period of .com bust, there were also really some good things that happened. So I think, you know, one has to just ride it out and survive. And some companies won't survive. Some companies don't deserve to survive. You know, I think a lot of startups have this mentality is, well, I deserve capital because I'm a startup and there's innovation and all the rest of it. 80-20 rule, there will be blood. Some blood will be unfortunate and some blood will be deserved.
Bring in one of the things that was said, and I think it was from Catherine, where she had mentioned that you know, there's a lot of experience that's required from a diversity, from an investment-focused perspective, and really just from a lender lens investing as well. And you know, currently what we're seeing is that a lot of VCs are then starting to structure a bit differently, where they're starting to merge or looking at closed-ended or open-ended funds. And then sort of to Kit, actually, one of the questions is, VCs are looking to alternative funding methods, whether through family offices, DFIs, or net asset value loans. How does this impact the structure of the VC?
Thanks, Karaba. Yeah, VC structures definitely an interesting topic. So there are many ways to structure a VC fund. But you know what I've come to realize over the years is, at some point, a VC, it's two co-founders as well. A VC business is also just a business, you know, or 2 or 3 or whatever. It's a couple of investment professionals having some M&A experience, or coming out of a bank, or some form of an angel investor, or a startup that actually had a massive exit and suddenly say, okay, well, you know what, I'm actually want to give back, and I know this asset class and I want to invest. And that could be very simple. If you are the sole decision maker as an angel investor or so, then there's not, you know, complex structures needed necessarily, because you know, you can structure for tax efficiency, maybe offshore or through a company or whatever the case may be, and one just invests. So I don't think one has to over-engineer it. But if you now start going into institutional capital and you say, okay, well, hang on, I need to raise this business model of VC is quite a difficult business model. If you go for the traditional 2 and 20, which basically means 2% fee for funds under management and a 20% upside of carried interest after hurdles. I think many people will be familiar with that model, but that does mean that the actual income of a VC firm is quite low until one gets economies of scale of larger funds under management, because then the 2% of $100 million becomes something, or the 2% of 300 million. You know what I'm saying? So I think from that perspective, scale matters. Now, there's a problem with this. There's a double-edged sword. What our ecosystems need desperately is seed capital, earlier stage capital, to get those businesses over the hump. But the larger the VC funds become, just economically, the up the ladder they go in terms of Series A, Series B type funding, because of the economies of scale. If you've got $100 million fund, you don't want to manage 100 $1 million businesses, because you don't have the capacity and the team and to manage that. Unless it is a spray and pray type fund, and there are some successes in that, to just say, look, limited due diligence, I'm going to invest in everything, and a couple may succeed and become unicorns, and the rest may fail, but that's VC. My opinion, that model does not necessarily work in Africa, because our ecosystem is not developed enough where you can really know where the next series is going to come from, or the next funding round is going to come from. In more developed ecosystems, it is less risky to play that game, because you kind of can say, okay, well, I'll give you money until April, and by then you can raise your next round and until December, and then you can raise your next round. Here, typically, you are the funder till April, you are the funder till December, and then you kind of start running out of capital because you and friends can't fund it anymore. Anyway, so therefore, the model of a private equity fund allocating a percentage of the capital under management towards VC is a good model. I mean, it happens. It's as long, again, in my opinion, as one has a dedicated team that looks at VC as VC, because the moment you take a VC deal to a private equity investment committee, they're going to look at the cost of capital and the returns and the risk and the EBITDA multiples and those type of things for businesses that don't have EBITDA. They might have some revenue, they might have a POC, and they might have a few interesting products that they've developed, but it's a bit difficult to value a business with a private equity hat on. But I mean, that's awesome, because you have a team behind it, you have the economies of scale and all the rest of it. I think in terms of merging or VCs working together, that's a model I really like. Most of our deals, we co-invest with other VCs, spread the risk a bit, have more brains and hands on deck when it comes to sort of board meeting strategy and all the rest of it. And instead of, I think that model works. But ultimately, one has to get more scale of capital under management, because of the fact that this is a long journey. One has to survive the journey as a VC fund. You have to add value. The model, nice model is always find, make, grow, realize. Finding interesting investments and investors, making the investments. You have to have a team that can value businesses, do due diligences, and really close the transaction from a legal perspective. Therefore, you need back office. You need finance people, you need lawyers, you need to pay for them. And again, to pay for them, you need to afford them. But then the hard work really starts in terms of the value add and the grow part. It's like, how does one actually gain market access for those companies with that exit lens on? And exits are difficult, especially in Africa. There aren't many IPOs. So therefore your exit is generally a trade sale to a strategic buyer. So therefore you need to know who that strategic buyer is. If you are going to have a fintech business that you are going to sell to a bank or to a Google or to a Visa, you need to make friends with Visa. People buy companies they know. So you need to make sure that you disrupt some of the client base, that you are having the right PR strategies in place to come under their noses and under their skin, so that when they do a scoping exercise of, we need to get into this space in a geography like Africa, your name comes up. That takes, a little bit of art and a lot of science, but all of that again takes time. So yeah, it's an interesting journey, interesting game, but scale helps. It depends what the flavor of the fund is. And then one must never forget that some funders, which is one thing I really didn't fully appreciate until we raised our recent fund, have some requirements that are not compatible with other funders. So for instance, Knife Capital, we could pass due diligences of various funders, but now you have to get them all in the same fund with the same mandate. And this one doesn't want to invest in South Africa. That one wants to invest in Africa, but not South Africa. This one wants to make sure that the business is more fintech. That one is, so you kind of like, ooh, now how do we get them all into one mandate and basically make sure that everyone's aligned around a common kind of purpose and so forth. So yeah, I mean, it is interesting to say the least, and it's difficult. But if you have track record and you can repeatedly show that you can get a company to exit, that you can add knowledge to the business model process, that you can add your networks to help with market access, and you obviously have the right amount of funding and the processes to do that quickly, you're on the road to success as a VC fund. But yeah.
So the seasoning to everything in the pot is to basically have a great track record and make sure that you get companies as quickly as possible to exit. Kunanani, I have a question for you, right? I mean, we need that track record, and there's like a lot of smaller ticket sizes that are currently happening, and I mean, it's not the best to actually invest into companies where you're thinking that it doesn't really provide much of a return for my overall fund size. I mean, obviously we then need government to get involved in some shape or form. So what policy reforms or interventions are required to make it easier for early stage VCs to raise capital?
No, thanks for that. I think from our perspective is that we have to cushion this ecosystem as government. And to do that, I think there are two possible interventions on our side. One is to provide risk capital in the ecosystem. And as a part of our innovation fund, which later on we'll discuss in other panel, we actually did that. We realized that in order for this ecosystem to be viable and sustainable, as government, we need to provide risk capital. And that's one of the key risks that as government we have to take. The second issue, I think it has to do with impact investing lens, because it's primarily about economic returns, but also there are other key imperatives that we have to take into account. The issue of gender investing that we think as government is very important. The issue of diversity and race for us is very important. So if we want to entrench that in the ecosystem, then we have to take the risk for that. And as a result, we think this risk as far as capital is concerned and impact investment is concerned are some of the interventions that we have to put in place. The critical other issue that I also think we need to really touch on is the issue of building the ecosystem. These small funds, they need a lot of help. So we need to seed some of our capital to assist them. For example, through our implementing partners, we actually have a number of programs to actually take them through the process to become so mature so that they can be able to stand on their own. So how do they do that? So we have to be also flexible in our mandate. So we have to allow them to experiment, the so-called warehousing approach. So we need to say, come on, we're going to give you some couple of rands, invest in 3 and 4 and see how this space goes. Because some of them are saying, no, we don't think we want to do this. Others were saying, no, we think we can do that. So we won't be able to make that determination if we had not taken that risk. So it's not really necessarily more of policy reforms for me. It's more about instruments and incentives that we as government, we need to plan. And I think we have couched that as part of our thesis for the Innovation Fund. Hence, I think we're in this platform today. Thank you.
Awesome. So basically, you just want to ensure that you're able to provide some sort of risk capital to the market and to VCs themselves.
Of course, we have vested interest. and one of that if we have to make impact in terms of jobs, in terms of transformation. We need to find the best way to do that. And we have seen that as government, we have been supporting a lot of basic research and development for years. And we've been asking ourselves, why are we not making impact that we should be making? And that's when we realized that investing in high-tech startups is probably one of the routes that we should take. And investing is not a government space for my mandate. Then we needed strategic partners to help us with that. And we think in order to grow the VC space, therefore we need to provide that first risk capital. Otherwise, the system won't tilt, so to speak.
Awesome, awesome. So basically, strategic partnering is very much important. And Catherine, I mean, what is your take then on smaller VCs merging, and how does this then impact capital raise, especially with the focus on female-founded businesses as well as diversity?
I'm not answering messages, I'm taking notes. Thank you for the good comments. Thank you for the question. So this initiative today, actually I think it was your brainchild, Audrey, to get us all into a room, and I'm going somewhere with the story. Audrey called a couple of months ago and said, hey, you know what, let's do something together as emerging funds. Let's get people in a room, let's have the discussion, and I thought that was a brilliant, brilliant idea at the time. If I look at the emerging funds in South Africa currently, we may look old, but I'm talking we're new in terms of emerging, demographic looks a little bit different, female diversity in terms of black fund managers. And we're currently on an IFC program, also an ecosystem support program. And I learned something very interesting last week about how biases can be a good thing and not a bad thing, because the diversity of biases actually brings so many better results and so many better ideas. So a long way to answer you, Karabo. I think there are a number of things that are going to happen. The emerging funds in the next 2 or 3 years, South Africa specifically, I'm not going to talk for the rest of the continent now. We know the individuals, we're a small ecosystem. There's a level of trust starting to develop amongst us as emerging fund managers to say, come a hell or high water, we're going to make this thing work for the startups. And that's the one thing. And the diversity, it's really a diverse group of humans who are really keen to do that. So that means the Harvard Business Review study 2021 says, if you have diversity in thinking and diversity in teams, diversity in investment committee meetings, diversity in your partner setups, complete diversity all up, white, black, male, female, you make 2.5 times more returns. Who doesn't want that, right? So whilst making the impact. So I do think one of 3 things, or a combination of things will happen. I do think if we can't raise the capital quick enough to really show the impact that we know we are busy making and going to do, there will be potentially some merging or some SPVs, but the job needs to get done. So without a doubt, that's the one thing. And then Kit said an interesting thing on LPs, and it made me think, the current LPs we have in our fund are flexible. They understand this problem. They understand this issue of emerging fund managers having to confirm the capital, and we try and contract for the flexibility. So where his funds, my dear partner, his funds are further down the line, we are able to bring some flexibility into contracting. And then the last point I wanted to make, so on that, so at worst, we will continue to do co-investments, because what we're currently doing, number of emerging fund managers in the room, we do co-investments. We build that company together, we make sure one focuses on giving more money, one focuses on grow, and so we will get to our exit. So it's a long answer, but I know this is going ahead. You know, we'll make this work until we show that the risk is worth it.
Right. I want to draw on one specific word that you said, which is trust, right? We really need trust in the ecosystem for things to actually work together. And you'll see a lot of the stuff, Kunanani, with VCs that are actually raising, saying that I actually have this level of relationship with my LP. There's this trust that I've already built with them. Let me actually go to them and raise the capital with them. But then there's still this notion of, well, I don't want to sort of be involved in the process. You have great stories, you have a great track record. We have this level of trust, but I don't want to get involved in your capital raising. So then my sort of understanding and just wanting to get your perspectives, why does that not work? When you're trying to raise funds, and you already built that relationship with that specific LP?
I wish I had a very straight answer. I don't, unfortunately. But my own observation is that it has to relate with the alignment of mandates at the core of it. I think Cult, in part, touched on it. I think you might find that the expectations, the vertical that I want to do, the impact investment that I want to look, they're completely different. But I think we're at a point where we have to learn from angel syndication approach, because that aspect of intervention works well. Why for LP not? I don't know. But I think the current financial situation that we do find ourselves in, as a country, as a continent, as a globe, I think it forces us to begin to leverage each other's expertise and strengths in order to drive the ecosystem. I think we don't have much of an option given the financial constraints that we are currently experiencing.
I want to bring Tashania and Audrey into this conversation, right? Kunana, you perfectly mentioned this element of mandate, right? So we will find that so the alternative asset class being VCs, there's only 0.6% that's actually allocated for in South Africa, 0.2% in Ghana, and 6% in Nigeria, right? So that's relatively low, given the fact that VC is such a risky category to actually invest in. So Tashania, my question is that, considering that 91% of emerging VCs find raising funds challenging, what specific measures or incentives can the public sector LPs offer to stimulate more fundraising activities, especially in emerging markets?
Thanks, Karabo. Great question. So I don't think it's a responsibility solely of the public sector, right? The public sector has done a great job. The department, like Okononani has spoken to, has established the Sovereign Innovation Fund, which has gone a long way in its pilot, through its pilot phases to supporting the ecosystem. And there's also been other things that the public space has done, like establishing institutions like TIA, and those sort of things. Because I do believe that we do need more instruments that sit in the seed area, in the development area, as to where Audrey sits actually. So we do need more development upfront and more money going into that upfront. And like you mentioned, such little capital does flow into VC. However, that's a certain percentage of a very large pool of AUM that gets allocated. And the quantum is really impactful in VC. So whether it's in seed or in Series A. So it's not about needing private sector or the public sector to intervene. We need collaboration between private and public. And that's been achieved through the Sovereign Innovation Fund. But I think, so it's about the collaboration, but it's also about the non-financial support that is needed. Because I think there's a lot of upfront non-financial support and structuring that doesn't happen. Because like he had said, in order to get businesses into exit, you need to structure them appropriately upfront. And you need to line up those exits upfront and have an idea of where you're taking the company to as the VC. Because often these companies don't have the financial skill in-house to be able to guide them from a strategic perspective into how they can scale their company, but also plan for exits for their current investors. And then maintain things like founder alignment and those sort of things. Because there's a lot of seed companies that come to us that have no founder alignment. And they need quite a lot of structuring from a governance perspective in order to get them into a possibility of exit when we want to exit. So I think it's a collaboration between public and private, but then also from a private perspective, we need to bring the financial skill into these companies to get them to a point of exit, which is, like my co-panelist said, very important for international investment and for basically crowding in capital from the international market. Yeah.
All right. I mean, or do we know that VCs have very low risk appetite, right? And so given this specific perspective from the institutional investors, what are the opportunity costs VCs are facing because of this?
You mean if we don't invest? Yes, so if you think about pre-seed to Series A, it's really the beginning of industrialization. It is really where new ideas that belong to a certain economy, in our case Africa, the creative energy lies. So if you do not invest in the early stage, you actually lose that capability in your economy. That's the creative economy, that builds the knowledge economy. So you're just creating a big gap, which then makes you an import economy instead of an export economy. Can you hear that massive opportunity cost? I actually think output for today could be that this room says, let's do a research project on what it will cost from an opportunity perspective if we don't get this right. So it's really meeting the market where the market is at. We need to commercialize our intellectual property and for me, I know I'm a South African, but I know the Mozambicans are in the room and the Kenyans are in the room. It's actually the continent of Africa. That is ownership. We need to own to change the world and take it to the world. So that's the biggest opportunity cost. Obviously, in the beginning phases, it's job creation. We lose out on that. It is solving our own problems. We lose out on that. We become reactive on that. Can you imagine? Think of Sasol. It was created here through intellectual property. It's now the RDC's one of their biggest assets. And it was created in this country from intellectual property to full commercialization. We need hundreds and thousands of those kind of companies. And don't take me on petrol, please, and coal and things like that. It's not about that now. I'm just illustrating. We need that in clean tech, we need that in education, we need that in fintech, we need it on food tech, and absolutely everything we do in Africa. So it's a gap. We're not servicing the missing middle, and that's the opportunity cost. We are paying an immense price as we sit here because we haven't created the follow-on pipeline for Series B. So that's why we partnered with Exio Capital. That's got a $350 million asset base that our startups can actually potentially benefit from. And that experience, a collaboration, but public-private partnership. I think one of the measures of the Innovation Fund is how much private sector money does this public first-loss capacity attract into the economy. Visionary work. We need that across Africa. So that's what my input is.
So basically, you spoke about the opportunity costs, specifically around job creation, making sure that we are in export markets, and I mean, obviously, with all these measures, we want to get to a point where VCs are going to be getting a bit more capital, but it still remains that VCs are a very risky asset class. So, Tishane, then, what measures need to be corrected to increase fund allocation to VCs as an alternative asset class?
So the great thing is we've seen a lot more inflows from the private sector and the institutional sector into VC. Not enough, not nearly enough relative to the AUM, but Reg 28 has really helped in this regard in terms of their alternative asset allocation. And there's more interest. I think there's more interest from an institutional perspective because of the organic growth that VC offers into the economy. Also from an impact perspective, I mean, we can't leave impact out. I think impact is one of the main reasons people should invest in VC. VC's inherently been impactful since day one. I mean, this the first answer the first question you ask is, what is your problem and how are you solving it? And that inherently has entrenched impact in VC. But I think what will take the VC market kind of to the next level is how we go about measuring that impact, and then how we go about implementing and monitoring that post-investment. Because that monitoring is really, really tough, particularly when founding teams and teams of startups are very pressed for time and they are like, wearing many hats and those sort of things. But I think there's a balance there, because the more we prove out the impact in the VC space, which is there, I think it's a no-brainer to see that there's just not enough studies done on it, and there's not enough data to evidence it. So the more we build out kind of that database and the evidence around the impact that VC could have, I think we'll see more capital flows into that. But that, again, is the responsibility of the capital allocator, so the VC, and not necessarily on the startups that need to. So yeah, I think that'll really drive investment from an institutional investor perspective. Yeah.
Thank you. And lastly, Audrey, why is there a need to correct the macroeconomic issues in Africa that are currently deterring LPs from investing, and what would the success of these corrections do for the industry?
Yeah, well, no, actually, it's such a big question. So if we can get it right to collaborate across countries and make Africa generally a safer place for Kadir to put his money into this emerging economy across political spaces, currencies, and it's such a big question. We struggle in South Africa to have a unified vision. And now we know, actually, if we can get a trade bloc to stand together, how attractive that would be, because you can just imagine. So I do think it's the future of Africa, ultimately. It might go slower than anyone in this room wants it to go, but we should not stop, because can you imagine if we've got free flows across the borders in SADC, and we can expand in SADC, in East Africa, West Africa, North Africa. We've got a 1.7 billion economy with an incredible emerging middle class. Can you imagine what an economic force this continent can be? So I think that collaboration is really needed on a macro level. I don't think I play there. I'm just trying to fix already to bring in $1 billion into Africa. It's like a drop in the ocean, but it will take a lifetime to get there, And I think you just need many of us in this room and expand it. There's and see it less than it's a collaborative space. It's not a competitive place. The Patek report has been used a lot, but $42 trillion, too little money in this space. So just the beginning of a number, just times that times 18 in South African rand, that's dollars, If we talk about $100 million fund, we're talking about a 1.8 billion rand fund. And it's nothing. It's nothing in this economy. So, no, we need it. We need critical mass. We need a lot of money. We need a lot of effort to shift this dial. And I think the pioneers in this room are wearing the flag. And some of us, when you wear a white flag, will be shot, unfortunately. But I hope that most of us can actually get the peace going and the collaboration and shift this dial permanently and influence things from the bottom up, in a way. Thanks.
We have come to the end of our panel discussion, and we're going to go into 2 breakout groups. So I kindly ask the room to sort of navigate to the 2 boards. We want to sort of get into solution mode, where you guys can then speak on the experiences that you guys have around fundraising or investing into VC specifically. And then we'll just spend 30 minutes there at each of the boards. You guys can then sort of put together your experiences or any solutions that you have towards raising funds, especially in early stage VCs. We'll then come back into plenary in the last 30 minutes as we're looking to conclude. When we do come back to plenary, we just ask that we just have one person from each of the groups who then going to feed back to the wider audience. It is currently 11 o'clock, so then we'll be back at 11:30 post the breakout sessions. Sorry. All right. So then in the breakout groups, all we're asking is that you go towards the board. It's just sort of solution towards the topic, how do we solve for funding in early stage VCs, really around the 3 topics about exit paralysis, the VC structure, as well as the investor sentiment towards VCs. And then all we need you guys to do is sort of find solutions, actual real tangible solutions that each of us can then walk away with, that we can actually use and solution for in the room.
Just one addition. We have some beautiful humans in the room, just recording, some journalists in the room. If you want to do specific quotes, just let us know. We want to really make this an ecosystem publication that goes out tomorrow. So just, I know Charles is at the back, no, there's another journalist in the room, but just speak to us. And then the 2 breakout groups, if we can make sure they're diverse because of this diversity in thinking, so that we don't all do the same jobs. I'm more talking about roles as a part of the diversity too. Thanks.
All right. Thank you, everyone.